This is exactly how I built a tax-efficient $2 million portfolio in 2026. Now, I've worked in finance in Canada for nearly 20 years. I've taught thousands of people how to invest and build multiple seven-figure portfolios for high net worth Canadians using these exact strategies. And I can tell you, affluent professionals and entrepreneurs keep making the same mistakes, holding way too much cash, putting assets in the wrong accounts, and missing out on advanced strategies that could keep more of their wealth working for them instead of bleeding away to taxes. So in this video, I'm going to show you the exact framework I use today to structure a $2 million portfolio the right way, tax smart, diversified, built for long-term growth, and according to one's risk tolerance and goals. Once you've maxed out your TFSA and RSP, the game changes. How you split investments across accounts can be the difference between compounding wealth tax-free or leaving thousands of dollars on the table. The three common mistakes I see with people that have maxed out their TFSAs, RSPs, and are now investing in their taxable accounts is that one, they treat all the accounts the same. Two, they freeze once they have maxed out their TFSA and RSPs, and then they just end up hoarding a lot of cash and GICs in their cash accounts. And three, they randomly place investments across accounts with no rationale behind it. And this tells me they're not thinking about the tax consequences today and in retirement, which will ultimately affect their after-tax returns and even OAS. So for example, a client who came to me with a bunch of dividend stocks, Canadian, US, and a huge concentration of a particular stock that made up like a third of their investment portfolio. Now that's the case because he worked for that particular bank for like 20 years. He collected a lot of options and he did not end up diversifying out of it. But there was clearly no plan in place because the placements were random and they selected stocks based on how high the dividend yield is. So I saw that they were holding $100,000 worth of US dividend stocks in their taxable accounts with a 3.2% dividend yield. On average, if they had placed their US dividend stocks in a TFSA instead, their net dividend income would be $2,800 instead of $2,050, a difference of $756 per year in tax savings. And of course, if the US dividends were in their RSPs, they will not be paying any taxes on their US dividend income. Now, you may think that's not a big deal, it's just $750 per year, but it adds up and tax savings compound. And this is just one part of the equation. With this specific client's portfolio, they could be adding an additional $4,400 in portfolio income per year, which could add over $125,000 to their net worth over the next 20 years. Now, when it comes to asset placement, ideally you want your growth investments in your tax-free savings account because everything grows tax-free. You want it to be as big as possible. And when you pull money out, it's also tax-free. Fixed income products will go into your RRSP, so things that generate interest income like bonds. And then for your taxable accounts, capital gains, Canadian dividends, those are treated better from a tax perspective. Even with the perfect asset placement, there's one wealth-destroying habit that I see affluent Canadians fall into that completely sabotage their portfolio performance, and that is the second mistake, cash hoarding. I see many people who max out their TFSAs and RSPs and then proceed to pile up a ton of cash because they don't know what to do with it because they get scared now that they're in taxable account territory. I had one client who maxed out her TFSAs and RSP and then proceeded to hoard over $600,000 in a savings account. So once we determined her asset mix, like her allocation of equities, fixed income, and alternative investments, I built a portfolio based on that asset mix where she was now fully invested and money working for her. I even helped her consolidate a whole bunch of her accounts so that everything is much more organized, and she also realized she had a lot more money than she thought. We placed interest-bearing products like bonds and structured notes in her RSP, growth funds like stocks in her TFSA. We want all of our TFSAs to be as big as possible. And tax-efficient holdings in her taxable accounts. So things like corporate class ETFs, which we'll get into later on, or return on capital investments like some private REITs. Now, of course, all these investments are not going to fit perfectly into these accounts due to contribution limits to the RSP and TFSA. And we also don't structure portfolios strictly based on taxes alone. Asset mix comes first, like how much of equities, how much of fixed income, and then the quality of investments obviously come into play before tax efficiency. Now, with this new portfolio mix, she would be on track to generate an additional $8,000 per year in after-tax portfolio income. Over a 20-year period, that could be potentially over $320,000 added to her net worth, and that does not even include additional savings that she's going to be adding to her portfolio. her average taxes paid would come down from 43% to about 25%, simply because interest income and savings accounts are taxed at your marginal tax rate. And the higher the marginal tax rate you're at, the higher the taxes you'll be paying from your interest income. And that's the effects of this cash drag. By the way, if you want help implementing these tax-efficient strategies for your own portfolio, you can click the first link in the description below and book a complimentary portfolio audit where I take a look at your current holdings and give you the next step. Now, this is where most traditional advisors stop, but it's actually where real wealth acceleration begins for sophisticated investors. Most Canadians never get exposure to true alternative investments. They might own mutual funds, broad market index ETFs, or maybe even a rental property, but that's just still scratching the surface. The reality is, what separates institutional wealth building from retail investing is access. Pension funds, endowments, and ultra wealthy families don't just rely on stocks and bonds, they diversify into alternatives. In my approach, I typically recommend allocating 10 to 20% to alternatives depending on a client's risk tolerance. And I'm not talking about speculative bets, I'm talking about investments that are designed for generation of income, repeatable returns, and reduced reliance on the stock market. For example, private REITs, real estate investment trusts, they can deliver strong returns, consistent income. What I like are residential and student housing REITs. Structured notes, I mentioned these before. These are usually issued by the big banks like RBC, BMO, National Bank, and they build in downside protection while capturing equity-like returns. They're actually classified as a fixed income product, so low risk. This helps diversify out of plain bond mutual funds or passive index bond ETFs. And some of the interest rates are much higher than a regular bond mutual fund. There are also funds that write cash secured puts and covered calls. They generate consistent income that are better alternatives to bonds and even provide higher yields than dividends. The benefits here are huge. Alternatives can help smooth out volatility, diversify cash flow streams, and increase yields so that you can generate more cash flow that you can reinvest back into your portfolio. And that's how your portfolio can grow even faster. Now, here's a catch. Many of these opportunities require $500,000 or more just to get in the door. But for investors who qualify, alternatives bring you closer to an institutional grade portfolio, something that looks and behaves very differently from the cookie cutter mutual fund most Canadians are sold. Now, here's where many wealthy investors lose control of their strategy and let their portfolios drift. As markets run hot, equity exposures can creep far beyond your intended allocation. This drift exposes you to unnecessary risk, especially in frothy markets where valuations are stretched. My approach includes conducting regular quarterly reviews to measure drift against your target allocation and also to make sure if there's any cash sitting there, it is fully deployed. The portfolios I manage are on a discretionary basis and they are actively managed, making sure clients' portfolios are in line with their targets and they're not holding too much cash. When an asset class becomes overweight, I rebalance, shifting funds back into balance. This serves two purposes. One, defensively, it preserves wealth, keeping your risk profile intact and reducing the chance of outsized losses in a downturn. Offensively, it creates opportunities to trim profits from overheated areas of the market and reallocate into undervalued ones, turning market swings into opportunities. This disciplined process keeps your portfolio aligned with the level of risk we agreed on. That way, when markets decline, the experience isn't a super unpleasant one. It's more consistent with the range of outcomes we discussed and what you're prepared to tolerate. While downturns are inevitable, rebalancing helps ensure your portfolio behaves in line with your expectations, not outside of them. I want to talk about dividend optimization. This is where we go beyond just growing your wealth. It's about keeping more of it in your hands. I mentioned it briefly before. Not all income is taxed the same in Canada. Eligible Canadian dividends are taxed more favorably than interest or foreign dividends. Capital gains are taxed more favorably because only 50% of capital gains are taxed. Asset placement comes into play here as well. We want to make sure you don't sacrifice diversification, but where you hold your dividend stocks, whether it's Canadian versus foreign dividends, they matter. Now let's dig into more of the advanced strategies. Here's a challenge. If you want to invest in ETFs that generate dividends or interest, that income normally gets taxed every single year in a taxable account. And for high income earners, that can mean a huge tax drag on your portfolio. Corporate class ETFs solve this problem by wrapping different types of income producing investments like dividend paying stocks or bonds inside a special corporate structure. Instead of paying out taxable dividends or interest every year, the structure is designed to recharacterize those returns into capital gains or even on a total return basis. Now, why is that important? Because in Canada, capital gains are taxed at a much lower rate than interest or dividends. And here's the best part. You're not taking on the risk of chasing pure growth stocks just to capture those capital gains. You can hold income generating assets, but still benefit from preferential tax treatment of capital gains. This is why corporate class ETFs can be such a powerful tool for high net worth investors who want tax efficient income without sacrificing diversification and taking on more risk. Then there's withdrawal planning. Instead of pulling money out randomly, we design a strategy that coordinates withdrawals from your RRSP, TFSAs, and non-registered accounts. This helps smooth your taxable income and reduce lifetime taxes. Now, you may have heard of something called an RRSP meltdown. This is when you deliberately draw down most or all of your RRSPs over a very short period of time, usually before government benefits like CPP and OAS kick in, before you're forced into large RIF withdrawals to avoid being pushed into higher tax brackets later in retirement. If you have a large RSP, those mandatory RIF withdrawals can balloon your income, increase your marginal tax rate, and even trigger old age security OAS clawbacks. By melting it down earlier at a controlled pace, you may actually pay less tax cumulatively over your lifetime. It's not for everyone. It really depends on each person's situation. An effective meltdown strategy usually spreads withdrawals out over several years, keeping you in reasonable tax brackets while reducing the long-term tax burden. Advanced income optimization is about aligning your investments and withdrawals with the tax system, so your portfolio works harder after tax, not just before. Lastly, I want to put everything together for you and actually show you what this portfolio looks like. A client has a $2 million portfolio between her and her mom, so there are varying levels of risk within here, but I just lumped everything together as a household. However, I do manage this separately because if each person has a different risk tolerance, each of their portfolios have to be aligned with their individual risk tolerance. For the purposes of this video, I just lumped everything together, and ultimately it looks like this. $200,000 across both their TFSAs, about $276,000 across LIFs, RIFs, and RSPs, and about $1.5 million in their taxable accounts, so just under $2 million. And overall, the asset allocation looks like 3% cash, 39% equities, 44% fixed income, and 13% alternative investments. So the equities portion, they are invested in a low volatility pension fund. That means they're generating higher dividend yields that are in lower volatility stocks, and also a growth fund. That doesn't mean the growth fund is in these non-dividend paying high volatility stocks like Nvidia and Tesla. That is not the case. This growth fund still pays dividends while managing volatility. They focus on fundamentally solid quality companies, and then about $98,000 in additional active funds, ETFs, like those cash covered puts and covered call ETFs. And as for fixed income, there are some individual bonds in here because of just how much is going to be allocated towards fixed income. So about $275,000 in individual bonds, $270,000 in bond mutual funds, $84,000 in structured notes, and about $230,000 in bond ETFs. And then finally, $155,000 of this portfolio is in private REITs, and about $100,000 in private equity and other types of private investments. In total, today, this portfolio is expected to generate about $85,000 in annual income, which works out to be roughly 4.4% yield. And remember, this does not include the growth of this portfolio. It is just based on the dividend yields, the interest yields that these products are paying out today. And that's the step-by-step approach I use to build a tax-aware, high net worth portfolio Following these steps will give you a clear framework for thinking about taxes, income, and wealth growth. But let's be real, implementing it on your own is not simple. Why? First, Canadian tax rules are complex and always changing. Second, some investment strategies require access to specialized platforms or products with higher minimums. Third, ongoing monitoring, rebalancing, and tax planning takes time and expertise. So you really have two options. You can try to do it yourself, fully aware of the challenges, or two, you can work with me and I will help you design and optimize a portfolio that's tailored to your goals, income, and tax situation, and that is aligned with your overall financial plan. If you want to explore that second option, click the first link in the description below to book a complimentary portfolio audit. I'll take a look at your current holdings and show you opportunities to make your portfolio work smarter for you. Don't forget to like and subscribe and follow for more.